Russia is broke, out of money. Section 1. Two forced concessions signal stress. Within a short period, Russia has taken two actions it historically avoids: cutting military signing bonuses and selling national gold reserves. Both moves point to short-term solvency pressures overriding long-term strategic interests. Section 2. Military bonuses were a pressure valve. High enlistment bonuses served two purposes: attracting manpower without mass conscription and spreading wartime income across families and regions. Reducing these payments signals fiscal strain and weakens the Kremlin's ability to sustain manpower without unpopular measures. Section 3. What bonus cuts really mean. Lower incentives reduce recruitment at a time of high demand for personnel. This increases the likelihood of forced mobilization or tactical shifts, both of which carry domestic political risk amid economic decline. Section 4. Gold sales break a core narrative. Gold reserves are central to Russia's long-standing narrative of fiscal responsibility. Selling gold undermines this mythology and signals that liquid alternatives are exhausted. Section 5. The debt myth explained. Russia's low headline debt is not a sign of prudence. It reflects limited access to bond markets due to weak investor trust. Debt is often pushed onto regional governments rather than appearing on the federal balance sheet. Section 6. Hidden debt through regions. Military and social spending is increasingly financed through regional budgets funded by central loans. This masks federal liabilities while increasing systemic fragility at the regional level. Section 7. Why gold matters for Russia. Gold functions as collateral where credit markets are unavailable. It is meant to stabilize currency and fund deficits without excessive money printing. Russia delayed using gold, relying instead on inflation. Section 8. Gold liquidity is limited. Only a portion of Russia's gold is readily sellable, primarily within the National Wealth Fund. A large share has already been liquidated, reducing Russia's ability to defend the ruble. Section 9. Sanctions shrink the buyer pool. Sanctions severely limit who will buy Russian gold. As legal buyers disappear, sales move toward gray markets at steep discounts, eroding value and accelerating reserve depletion. Section 10. Inflation masked reality. Russia sustained the illusion of stability by printing money to support wages and spending. This strategy is reaching its limits as inflation accelerates and revenues decline. Section 11. Energy revenues are under pressure. Attacks on refineries, ports, and tanker logistics increase costs and reduce export revenue. Insurance premiums and transport disruptions further strain cash flow. Section 12. Why Moscow looked fine until now. Urban centers were insulated through inflation-funded spending. That buffer is eroding as bonus cuts and asset sales spread financial stress outward. Section 13. Structural weakness, not optics. Cutting pay and selling gold are last resort measures. Together, they indicate a deeper structural imbalance rather than a temporary adjustment. Section 14. The trajectory forward. With declining energy revenue, shrinking reserves, and limited borrowing capacity, fiscal pressure will intensify. Regional failures are likely to precede federal stress. Section 15. Core takeaway. Russia's economic posture relies on concealment and inflation, not resilience. Forced concessions show that the margin for error is narrowing. Final note. Headline stability can persist briefly, but underlying math ultimately asserts itself. These signals suggest Russia is managing decline, not strength.